increased financial regulation. But it's really not about Britain's lack of willingness to sign these treaties. Britain was simply defending its right to be the Ponzi fraud capital of the entire world, with a debt to GDP ratio of about 1,000%. So Britain is more the center of this in many ways than the EU, but it's not part of the Eurozone. So the pressure is not currently on Britain because the focus is on Europe. But Britain, as a major financial center, has an unbelievable amount of pain coming to it. But sterling might benefit temporarily from the problems of the euro, so you get capital flight from the Eurozone looking for safe havens, and even Britain might look good temporarily, but ultimately Britain has a massive price to pay.
I did not know that. So Britain has a worse situation than some of these European countries, it sounds like.
It does. It has an absolutely enormous financial sector, very much like Ireland had not so long ago, or Iceland. So a financial sector that's grossly disproportionate to the scale of the real economy. They've actually offshored almost all wealth creation. All they have is North Sea oil and gas and money chasing its own tail in the City of London. And they have no rule as to how many times you can pledge your little bit of collateral for more and more and more loans. So Britain has been the center of so many problems when it comes to the disparity between collateral and the size of the effective money supply. The problem is that when you do that, you're playing a giant game of musical chairs. And while the music is still playing, people don't realize there's about one chair for every 100 people playing the game because they're so distracted. But as soon as the music stops and they realize how few chairs there really are, how little collateral there really is, there's a massive grab. And that's exactly what we're seeing. That's with the assets disappearing from MF Global customers' accounts. They were all rehypothecated multiple times through London because London had fewer limits on this process than America. So the globalized financial system has allowed capital to find where it was the least regulated and to exploit that to the nth degree, which is exactly what it's...
Which is London, that's right. Well, let's move on to what may affect our viewers out there more so, the stock market. Even if they don't directly invest, they are invested through their 401ks or IRAs or whatnot. Where do you see the United States stock market, or world stock market for that matter, say by the end of this year?
I think it's going to be thousands of points lower than it is now. I think it will take out the March 2009 low and then some. Probably significantly lower than that would be my best guess. Basically, the trend changed on May the 2nd this year. What happens, because these trends are swings of positive feedback, they pick up momentum as they go along. So they start slowly and build up. I think we're getting to the point where we're going to see market cascades, where we're going to start to see things break to the downside and substantial moves, things that people will look back on and call a crash. It doesn't mean that it goes all the way to the bottom and all the deleveraging happens at the beginning. No market ever moves only in one direction. There will continue to be rallies, there'll continue to be short squeezes and sucker moves of all kinds. There will be huge volatility. So not just enormous moves to the downside, but enormous moves to the upside as well. And if you look at the history of the market in the 1930s, the largest up moves were during the Depression, during the market crash years, because you'd simply get massive volatility. And that's going to be very much characteristic of the markets for the next several years, I would think. It's a place where there will be some opportunities, some enormous opportunities, but you have to be right and lucky, partly because the regulatory environment will almost certainly be rewritten to favor insiders and the well-connected. So there will be many more opportunities to lose your shirt than opportunities to make an awful lot of money over the next while.
But now if investors, at this point in time, after the market has dropped several thousand points, if they invest in solid large cap companies that are profitable, then the dividends from that might be as safe as, almost as safe as U.S. Treasuries?
I don't think they will be as safe. We don't know what will actually survive. I mean, people say, but if you were invested in the market before the 29 crash, if you'd stayed invested, you would eventually have made money. And I think, well, maybe 25 years later, if you had guessed the right companies to be invested in beforehand, and considering how many were delisted, your odds would not have been good. So when people simply don't have access to purchasing power because they haven't got access to credit, they're losing jobs, unemployment goes through the roof, they don't know when they're going to be earning another paycheck, they stop spending. So you have an economic seizure because the velocity of money falls off a cliff. Money simply stops circulating in the economy, exactly as we saw in Japan. That was a major part of their two lost decades. Under those circumstances, things that are currently profitable, there's no guarantee they will continue to be profitable or even survive. Some of them will, many of them won't, and we don't necessarily know in advance which ones. What I would say is that dividends are going to make a major comeback. We have seen dividends basically disappear because everyone was looking for capital gains. It was all supposed to be about share price growth, and who needs dividends if you're going to make an enormous amount of money on share price appreciation? When nobody thinks share prices are going to appreciate anymore, and in fact they think there's a very substantial risk they will continue to fall, they're going to be looking for very large dividends. And yes, that will be a way of generating an income if you guessed right and you guessed something that will continue to be able to pay out. It's going to be very, very difficult as a financial environment, though. It's very difficult to invest in doing anything with your business if you're having to pay out very large dividends. But I think that's very much where we're going. At the bottom, the bottom there, they say, buy when there's blood in the streets. And what they really mean is buy when people wouldn't touch stocks with a barge pole, when the received wisdom is these can only ever go down. Because that's when they're cheap, because nobody wants them. People are practically giving them away. If you look at the environment now, that doesn't describe where we are right now. People are still looking for the next big thing. When people really want something, it's never going to be cheap. So we're far closer to a top than to a bottom at the moment, even although we're below where we were in 2007. We really haven't seen anything yet in terms of where this market is going to go.
Well, as far as the Dow, since 2007, it's pretty much at the top, 12,000, over 12,000.
It's still below where it was. It's a recovery high.
Where was it in 07 or 06? Oh, I see. All right. So, but as far as since the collapse, so to speak, it's up there. So it's not the time to buy, it would seem like.
Oh, most definitely not.
Yeah.
In fact, I would say it's definitely the time to think about selling because we've had the rally. There really is virtually no upside that one can count on. The risks are enormous compared to what they were and growing by the day. A lot of people have stayed invested trying to recoup the losses from 2008. Basically, they're likely to lose it all again and more if they don't get out now. People have to accept they've made back a certain amount of their losses, but really, the market is not the place to be at the moment. Cash is king in a deflation. There are so many trends that reversed. It's been months now we've been into this new trend, but it's picking up momentum and people haven't recognized it yet as the prevailing trend is now down.
All right, well, let's move on to China. China's been holding